All right, we're coming to you live from the Fox 2 newsroom right now, and joining us now is David Hall. He is with Hall Financial, a familiar face here in Metro Detroit, of course, a money expert and a guy who knows a thing or two about, what this Fed interest rate hike really means. And, you hear about this stuff on the news. We reported upon it yesterday. We've been talking about it for a few days. But you may be asking the question, what does this really mean for me? So we have so many Fox 2 viewers who are asking questions right now, and David's going to be taking these questions live and basically answering them really well. The great thing about David that I love is he's able to explain kind of highbrow, high-level stuff in a way that relates to people. I mean, you and I, we're just trying to get through our days, and maybe you have someone in your family that wants to buy a car, buy a house, and they have questions about how this interest rate is going to affect them. Well, you can ask questions live on our chat, by the way. And so right to the right of me right now, I have a screen. And on this Fox 2 YouTube chat, you can ask anything you want, and I'll take your question. Well, most of the questions, depends on what you ask, has to do with interest rates. We'll answer it, and we'll answer them live right here with David Hall. So, David, good to see you. Thanks for joining us. I wanted to begin by asking you, when you hear about the Fed raising the interest rate, we sit back and we say, all right, the guys out in Washington just kind of did this hike, but what does this really mean for the everyday person who's watching?
Well, so far, not much. I think the interesting thing about what the Fed does is the Fed kind of sets the tone for the economy, or at least they try to. So when they do things, it typically doesn't immediately mean much. Some interest rates may go up slightly here and there, but it's not a major thing. It's more about the Fed addressing economic conditions. And in this case, they're really trying to get control over what is a growing inflationary problem in the country that most of the viewers know about. And so trying to tame some of these prices, get inflation down from these, recent historic levels of nearly 7%, down to a more normalized kind of a number like 2, 3, 4% is their number one goal. So by raising rates and by talking about how they're going to continue to address things by raising rates, that typically will curb inflationary pressures. So for the viewers, I think it's good to know that the Fed is trying to act on some of the major concerns out there around gas, the prices of food, and everything else for our everyday living. But it doesn't mean a lot to anybody yet, although as the Fed continues to raise, we will see that come through in different things like mortgage rates, like auto rates, home equity lines, and other rates. So it's sort of not much right now, but it means that we're on, I think, the right path for what we need to do to right size the economy a little bit, given the inflation, which is the biggest deal.
Yeah, and inflation right now, by the way, we already have questions coming in right now from several viewers. James Klein will be getting to your question in just a moment. Tim Block will be talking to you about interest rates as well with David in a moment here. But I wanted to ask you about the war in Ukraine and how that affects what's going on with our interest rates. There's a saying, what happens in Vegas stays in Vegas. Well, what happens on the international stage, sadly, doesn't stay on the international stage. It affects all of us. And so when you take a look at this war in Ukraine right now, how does it affect our economy and really interest rates as you see them?
Well, a couple of things. I mean, obviously on a humanitarian level, it's disastrous and it's
Right.
horrific. And that's, where my mind always first goes to because it's just terrible. Sort of secondarily, on a financial level of a distant second, uncertainty is never good for the markets. And so you'll see situations where uncertainty about things like war will create a very a wide range on a daily basis of the market going up and going down. I think it's an important thing to note that the quicker that there's resolution to what's going on in Ukraine, the better it is for markets in general. And so it's never good to have uncertainty from the standpoint of short-term interest rates moving up, stock portfolios moving down. It's not a good situation. But long-term, it ends up sort of level setting in the end. But the war is not helpful for inflation either. Obviously, we've seen a number of stories where, supplies and other things that, we potentially depend on or have always, gone through somebody else for, now is, you have a change in how we're going to do that. So I would say it's not good financially, and it's even worse on a humanitarian level.
So, speaking of supply, Shayna Rose is one of our Fox 2 viewers. And Shayna, thanks for your question. She's asking us this. She says the Fed is raising rates to try to slow inflation, as you mentioned. But Shayna's asking, how effective can that be when most of the inflation right now is caused by a lack of supply? She goes on to say higher wages are also driving inflation, and the Fed doesn't want to stop that. What are your thoughts on that when it comes to, the lack of supply is what's causing this? So how do you correct that?
It's tricky, because then you throw in a pandemic on top of all this
Right.
that caused a lot of these supply chain issues. So she's not wrong in part of that analysis. And, when people want to make broad sweeping statements about the economy, it's like they're usually somewhat partially right, because it's complicated. So I think that, some of the supply chain issues that have not been solved that need to get caught up. I mean, if you just look at ordinary things these days that you may have ordered and gotten the next day that can be months right now, it's an issue. And I don't know that raising interest rates is going to solve that piece of it, but I think there's other pieces of the economy where raising interest rates is the right thing to do, given all the information we have today. And the other interesting thing, to that point is that this is all fluid. I mean, the Fed says we're going to raise 6 times, They also said a few months ago they were going to raise 3 times. So they just the guidance will change based on the information that comes out. That's why it's very difficult to make predictions, because things change. And I don't know that in the month of May we might be talking about something a little bit different. I mean, I said at the beginning of the year, and I felt pretty strongly about it, that the 2 worst kept secrets in our business are that home values are going to keep going up and interest rates are going up. And,
Sure.
We were right on both of those things, but any variation of something in the economy can change that. But I think that those were very likely scenarios that we were going to see mortgage interest rates rise. We were also going to see home values continue to appreciate, not the least of which is because we have a lack of supply of homes. And we'll get into that a little bit later, I know.
Yeah, I wanted to talk to you about that lack of supply when it comes to homes, because that's so interesting, and it's what your bread and butter. So much of that is about looking at that supply and how that affects prices and interest rates. But I want to get to Ronald here, and since you're an expert when it comes to so much when it comes to finances, Ronald Pretty, on the Fox 2 Facebook page saying, "Hey, I'm thinking about pulling all of my investments." When you hear someone say that, what goes through your mind?
That's a mistake. That's the first thing that goes through my mind. I mean, look, timing the market is incredibly difficult, and you hear that time over time. And you could get lucky. You could pull your money out of the market, put it in cash. The market could go down another 10%. You could put it in the market, and then it could go up. But it usually doesn't happen like that. Like, it's very hard to call the bottom or call the top, or we could see a reversal in this market any day where the market moves up 7% in one day and you've missed all those gains. So I just think trying to time the market is a very tough game to play. I know that a small percentage of people try to play that. I've never met anybody that successfully has timed the market.
Yeah.
And I've been at this for 25 years. I think if a lot of people knew how to time the market, they wouldn't be working. So I think that's incredibly difficult. And all the smart investors I know is they treat it as a long-term investment. Now, if you're at a certain age, if you're, a little bit more experienced, you're maybe in your 60s or your 70s and you're worried about the market and you want to pull some money out, that's a little bit of a different story. But if you're a long-term investor, I think timing the market is incredibly difficult. You have a 5% drop one day and 8% rise the next day. How are you going to time that? That's tough.
No, that is tough. And if we all had a crystal ball, like you said, no one would be working. I wouldn't be doing this job. You wouldn't be doing your job. We'd just be hanging out and making the right investments. But if you're just joining us, we're talking to David Hall with Hall Financial. He's taking your questions when it comes to the Fed interest rate hike. You hear that all the time on the news. Hey, the Fed's going to increase our interest rate. What does that really mean for you and I? When it comes to buying a house, buying a car, you made an interesting point, David, when we talked just yesterday on TV. And also today at Live at 11, you basically said, look, buying a car right now, the interest rate hike isn't really going to affect you right now because it was such an incremental increase. But over the course of many increases, we're going to be talking about, if the Fed ends up increasing the interest rate one time, that's one thing. 2 times, 3 times, 4 times, 6 times, now you're talking an impact, right?
Yeah, that's right. And at the base and core of it all is the Fed is banks lending money to other financial institutions, which all kind of trickles to everything else, just so everybody understands that, because I think that's an important thing to understand. So it's not a direct mortgage rate hit or anything else. You will see it quickly find its way into home equity loan rates, though, when the Fed raises. So that's something to keep in mind. But again, it's a quarter. It wasn't a major raise. But yeah, these things will, end up sort of getting into the system. The markets, the financial markets, had a lot of this already priced in. If the Fed hadn't raised, it would have been really interesting because, everything preceding the Fed raising the other day was that in anticipation of them doing that. And for folks that don't know, a lot of trading that goes on in the markets has to do with market anticipation, not necessarily market reality that day. So I think that the market is going to continue to look to the Fed to raise rates as they've sent their guidance out. And that won't be a surprise to the market on that day. More of what the folks on Wall Street look at is what are the comments that are then made after because they know they're going to raise or lower for the most part when they do it, but then they want to see the guidance. What are the comments? How are they looking at the economy? How are they thinking about inflation? And certainly Jerome Powell has taken a different stance. Not 4 or 5 months ago, he sort of was saying inflation is not that big a deal. Now he's saying it's a real deal and it's, a little bigger deal than we may have thought. So it changes, sort of the stance, I guess, to some degree. But to your point, and I think it's an important one, when the Fed raises a quarter, that doesn't really do much to the average person that day, but it will trickle into different things that they pay on, whether it be mortgage rates, home equity lines, credit cards, car loans over time.
And let's talk about the effect of this. I mean, a lot of this stuff to you, David, is obvious because it's your bread and butter. It's what you do every day. But by the Fed increasing the interest rate, what's the goal here? The goal is to, by many people's account, is to basically slow down the purchasing, slow down the economy in a sense, because it's kind of like an out of control car. Is that how you look at it? I mean, is that the reason for this?
Yeah, I mean, 0% Fed funds rate or 0% interest rates, which is what we've been living with the last couple of years to stimulate the economy during a pandemic, is pretty unusual. So it's not like rates are being, they're being raised, but we're sort of getting them back to normal to some degree. If you look at a 25 or 50-year chart, we've been in unusually low territory. So we're sort of getting back to reality. The Fed was trying to curb a lot of economic woes caused by the pandemic and other factors. Now, I think something that's important to note as it relates to that is that as the Fed continues to raise rates, they will look at, where are we in the world today economically and potentially change their stance. But folks over the last year or so could buy a home and finance it, for instance, at like an interest rate in the 2s on a fixed rate.
Yeah.
That's just an incredible thing. I mean, even today, getting a rate in the 4s is great. If you talk to anybody historically, hey, I'm mortgaging a house, I'm getting fixed rates in the 4s. Oh, that's really good. And sometimes we lose sight of that. And I think that, everybody being able to purchase with abnormally low interest rates, historically speaking, is something we sort of got used to. So now it feels like a race. The other thing I would just say about that is that if you look at interest rates historically and you look at fixed rates, we're still well below any type of average over any extended period of time. So again, the Fed just kind of bringing things back, what I would call to somewhat of a reality after giving everybody, corporations included, a lot of purchasing and borrowing power at a very low interest rates. I mean, one of the reasons stocks, and we're not going to get into this too much, have been, flying high is all these companies can borrow money very, very cheaply, which is a great stimulation. But that's not reality, really. That's kind of a moment in time that was really good for them, and kind of keeping that in mind on a historical perspective, I think, is important.
I think that's why we have you on. I mean, we do the news every night, and last night you just gave such good perspective, and again today live at 11, talking about how we talk about an interest rate hike, and all of a sudden people get excited, or and you reminded us this was like 2019 levels that we're looking at here, and 2019 levels were pretty good. And so if you're looking at, like, we rewound the clock just by a couple of years to slow things down. Nothing to get too excited about. It's over the course of many months that we'll have to notice a difference here. Roman does have a question. And by the way, just like Roman, if you have a question right now for David Hall with Hall Financial, you see him on television doing commercials. He's on the news regularly. This is a great opportunity for you to ask anything that you have in your mind about something that you're really curious about. And Roman is taking advantage of that. Roman is saying, hey, people are paying 30 to 100,000 plus more for homes than three years ago. They're asking for more, per house. Will prices drop, or is this the new normal market? Because we heard, David, that things will stabilize, cool down. We even heard people say the housing market is cooling down. Well, compared to 5 years ago, sure, but it's still pretty hot. What do you tell Roman about those prices?
It's such an interesting question. And I can give you a little perspective on what's happening in the market today. To predict the future is really tough, but I'll give it a shot. So the first thing is that one of the reasons housing has been in such demand are these incredibly low interest rates. So you can buy a house and you can mortgage and get a payment cheaper than you ever could in the history of ever. So that's a long time, So that's number one. Number two is, if you're thinking about buying a home where there's not a lot of inventory and there's a ton of buyers, so you have to pay over asking to get a house, actually, as interest rates rise, it should make it less of a seller's market and a little bit more of a buyer's market. So the interesting thing about rates going up, buyers are kind of saying, I wish the payment was, $70 less, than it is now. But you actually you have a better chance of getting that house now, because it's flushing out buyers that maybe aren't as attracted to the market. And in an exaggerated example, if rates went to 10%, there'd be way less buyers than there are 2%. I mean, it's simple math. So the housing market being such a seller's market is actually going to curtail to some degree, or should, as interest rates rise. So if I'm a seller or thinking about being a seller, let's say for like the last year, but it's been so good, so I'm making money on my house, it's sort of a call as rates rise to get sellers off the fence, because I don't know that we're going to shift into a buyer's market anytime soon, but we're going to be shifting away from such an unprecedented strong seller's market. I still think housing values will go up because we still have very low interest rates and a lack of inventory. But as more inventory comes and rates go up, that's why you see the shift over to a potential more of a buyer's market. It's just a really, for sort of a guy like me who's kind of, I'm very interested in this stuff, maybe a little nerdy. Right. It's fascinating to see these things, and as they ebb and flow, monthly reports that we get, not just about inventory, but interest rates and how it all sort of shakes up the market. Short term, we're going to be in a situation where you still potentially have to pay over asking, or, in that area. But I think that will flush itself out over time. And I don't know if it'll be this fall or next spring, but I think you'll see a shift more of a balanced market than this heavy seller's market we've been in.
But we have already seen a slight shift, right? I mean, I remember my wife and I bought a house a year and a half ago, and it was crazy. I mean, we sold one house and we had to quickly figure out if we were going to live in an apartment, temporarily, because we certainly didn't want to do that, but a lot of people have had to. And we were lucky to find a house that we liked, and we got in there, although everything in the house is from 1995, and 1995 called and they want their house back. But guess what? It's a great set of bones, a wonderful location, and we love our neighbors, so it's nice. But the bottom line is, a year and a half ago was different, and it's cooled down since even then, wouldn't you say?
Yeah, I mean, but it's still, I'm telling you, there's still a lot of over asking offers, appraisal guarantees, inspection guarantees. I'm not a fan of inspection, guarantees. I think that when you buy a house, it's a serious investment. I think a lot of buyers get impatient and just they finally find a house, and so they'll do anything to get it. And I believe you have to do due diligence on a house. Like I'm not
But
a
David,
big
real
fan
quickly,
of that,
the
but
inspection guarantee, just to explain that, I know that's easy.
oh,
But that basically
got
means
me.
like
Good, see?
waiving the thing, right?
Yeah. Oftentimes in this market, buyers will make offers because they want their offer to be more attractive. That
Right.
I'm not putting you through an inspection period of that's usually when you can back out of the deal if you don't like the inspection. In an appraisal, if it comes in low, they'll guarantee a certain price on the appraisal that they'll pay the difference of. So thank you for slowing me down there.
No, but bad idea though, right? Bad idea.
Bad idea. Yeah, I mean, if you really know you want the house, and I don't know, I think an inspection is really important when you buy a house because there's certain things you just can't see that may be going on that you need to be able to address. So yeah, there's some wild things happening in the market from more frustrated over time buyers that just want to get a house. I think you got to be careful about that. But yeah, it's still very much a seller's market, and there's a lot of homes going over asking. That has cooled a touch, but it still really leans towards the seller today in terms of who's kind of got the power. I mean, people put their house on the market and they know in a week or two they're probably going to have multiple offers, if not double-digit offers. I mean, it really is that strong.
What kind of a disaster scenario have you seen when people waived the inspection and they just, desperate to get a house because the market's so hot? What happens to people? Give us an example.
Yeah, I mean, in simple terms, you could have $20,000 or $30,000 in repairs that you didn't even know, whether it be mold, asbestos, something that's going on with the foundation of the house. I mean, there are like some very important things, I think, that you need to have an inspector sort of give you the checklist of, hey, if there's a crack in the foundation of this house, I need to know about that before I purchase it. And it may be the seller may not even know about it. It's not necessarily even anything that anybody's trying to get away with. It's a discovery phase. I don't know about you, Roop. I go into a house, I look at it, and it's like, man, this thing looks nice. Well, I have a buddy of mine go in who's maybe more of an inspector type of a mentality. And he's like, I don't like this. I don't like this. Yeah. I'm like, well, wait a second. I thought it was a nice house, Yeah, right. So I'm just the finance guy. He's the inspector. And so I got to stay in my lane on that. And so for me to go in and say, yeah, I'll buy the house, waive the inspection, I just want it. I want to know about what's going on there. I think that's an important thing. And I think that real estate agents, for the most part, have their clients doing that. But sometimes you get an over exuberant buyer that really wants to just get the house and wants to separate their offer from everybody else's. And that's one less thing that a seller has to be concerned about, is that inspection phase where somebody might back out of the deal. So I wouldn't say it's like prominent, but it happens. It definitely happens. And I think folks need to know about that.
I couldn't imagine. I mean, and it's just having just bought a house, it's such an important purchase and such a big purchase, and you're borrowing so much money to make this happen. We saw one house, and I know, like you said, you're a mortgage guy. I'm a TV guy. I mean, we'd like to think we're relatively smart people, but when you get excited about a house, we saw one house and we're like, oh, no big deal. It looked like the side of the house that was on the brick. It looked kind of wet, but the thing is, it hadn't rained recently, right? I mean, so just a little thing. And by the way, when I say wet, it wasn't like soaking wet. It's the expert went and touched the side of the brick. He's like, it feels a little moist compared to where it should be. And then we went and looked at it, and he was like, well, it could be because there's water retention and, in the walls, there's stuff that we just don't understand that we have to depend on the experts. And so it's such a good point about waiving the inspection. I think that's so important.
Yeah. And then for the most part, most inspections come back, pretty clean with very minor stuff and so just to have that, though, I would want that peace of mind when I purchase a home, and I recommend that.
No, very cool. Hey, so if you're just joining us, and David, get a sip of water while we switch the camera to me, and I'll just kind of reintroduce the topic here as we chat with our Fox 2 viewers. Lots of good questions coming in both on Facebook, on Twitter, on LinkedIn, and on the Fox 2 YouTube channel. We're talking to David Hall, about interest rates, but if there's something else you're interested in as well when it comes to anything home related, when it comes to home purchases, ask away. This is your chance. You can just leave the question in the chat. I'm watching for your question now. One question is coming to us from gentleman on Facebook, and then also on our YouTube channel, Jay is asking the question that this person's asking. It says, good morning. We're looking for a new car in a few months. How much will this affect the payments? Jay is saying, hey, look, I joined late, but we'll be in the market for a minivan soon, and the prices are already huge. Will the rates fall again in the near future? Should I wait? That's a really good question.
All right, well, I can do one thing at a time. So let's talk about the car thing first, then you'll have to ask me the other one again. So the simple answer is 10 or 20 bucks a month. It's pretty nominal depending on the size of what you're doing and everything else.
Sure.
But, and in some cases, if the dealers needed to, they could eat some of that if they're trying to push product. But we know right now that nobody's got any cars, and that's another inventory problem that we have. So I don't see them doing that. So again, very nominal on, how much you're going to be paying more for a car. What was the other one, Roop? I'm sorry.
Well, yeah. So Jay is asking the question that they're in the market. Basically saying, look, they're gonna want a minivan soon, and the prices are already really, really high. So what this person's asking, Jay's saying, hey, will the rate fall again in the near future? Should I wait? Because if you wait, then and they do what they were promising, which is another few increases, now it's going to cost more in like 6 months, right?
Yeah. Given all the information that we have right now, it's not going to fall. It's going to go up. That could change. And I've seen enough, I guess, in my 25 years in this business to know that things can change. But given the information that we have today, waiting is not a good option.
So even though it's not, car prices are up, right? People are paying more for things, and it takes forever to get what you want. So by the time you get the financing done, you order your car and you sign the paperwork, you're already talking a few months. You're saying, hey, look, if the Fed's promising to do what it's going to do, we're going to see probably things go up, not down. So smart move there.
Yeah, that's absolutely right. And I think we're going to see that, on more than just cars, like we've talked about before. Yeah. I think that for folks that have credit card debt, and the numbers are still pretty, they're big in terms of how many homes, meaning families, carry over $5,000 in credit card debt on a continual basis. Paying off that credit card debt is going to become more important because rates are going to rise on credit card debt also. And I think it's important that we get the word out on that because, throwing money away on high interest credit cards can easily be avoided with a couple of different means. The best thing is if you have the money to pay them off, you should get them paid off each and every month. We've talked about that before. You can also utilize the equity in your home to pay them off and get a much lower rate. The first best thing is your own cash. Then separate from that is potentially using some of the equity in your own home. And as those rates go up, especially if you have $10,000 or $15,000 or $20,000 balances, I would get working on that now. And I've designed with some folks in the past, like a plan to sort of do that over a 6-month period of time. A lot of times we can't see any light at the end of the tunnel on credit card bills, and we can't pay them all off right now. Okay, well, let's design what I consider to be a short-term plan. 6 months is pretty short-term to pay off some debt, where you can have a discipline about paying it off and making some dent in that number. I think we get on this hamster wheel sometimes of not making any progress there. And that's something that, has been important to me to talk to people about over the years that I've been doing this.
And that's such a discipline, though, for all of us to be able to sit down and look at our debt. I mean, think about how personal that is, right? I mean, you think about, people's relationships and then their money, the two most private things in their lives. And to sit here and say, look, we got to now open this up and examine what's going wrong with our finances, see if we're going on the right road. It is the last thing anyone wants to do after a stressful week. But you're saying, look, sit down, do like an audit, so to speak, look at what you have going on and open it up and start. Because if you wait, it's just going to get worse.
That's right. And I mean, in simple terms, and I've spoken about this before, but I think it's important, is that you have good debt and you have bad debt. And for the most part, it's pretty clear what they are. I consider good debt to be low interest rate, tax deductible debt. You get a double benefit, you got a low rate, it's tax deductible. That's good debt. That's your mortgage debt for the most part. Bad debt, high interest rate credit cards, things that you can never get ahead on, where the balance stays the same every month and you're just paying the interest. You're not making any headway.
They love
other
you.
Bad
Those
debt.
credit card companies love you.
They love you. That's how, I mean, that's how they make money. You know, they don't make money from people that pay off the debt every month. They make money from the people that pay high interest rates. And for the consumer, it's not tax deductible. It's a high rate. It's just you're flushing money down the toilet to some degree. So and then, you know, in between that, you know, car loans are usually fine. Student loans, depending on the rate, you have to take a look at that. And then there's a lot of other type of debt. But your two extreme examples of good debt versus bad debt are your mortgage debt, that hopefully you got a really good credit score, that you have a low interest rate on, that you get a tax deduction on. And then the worst kind of debt is your high interest rate, credit card, not tax deductible, 16%, 19% interest that you're paying every month and you're never making any headway. I think it's really important to sort that out.
All right, David, if you're just joining us, for anyone else who's watching, we're talking to David Hall with Hall Financial. He's taking your questions right now about the Fed interest rate hike, also talking about anything that has to do with home purchases, interest rates, and credit cards. We have some questions coming in right now. If you have a question, just go ahead and hit us up on the chat here on the YouTube channel. I'll take your question live on the air. We have Tara who's asking David the question, is it smart to get a pre-approval if I'll be shopping for a home soon, or should I start shopping and find a house if I'm interested in first? You know, the order of how to get out the door and start this process really is confusing for a lot of people.
Yeah, and it used to be less important than it is now. So, you know, years ago, when it wasn't as much of a seller's market, you could go out and look around and the seller would sort of be hoping you'd make an offer and you take your time, get your pre-approval on your time, get back to your realtor when you want. But that's not today's market. That's not going to work. That is a bad idea. The first thing that you have to do is you got to go out and you got to get pre-approved, and you got to get a really solid pre-approval where you are giving documents to the lender so that they can issue you a really solid pre-approval. So when you make an offer, the realtor and the listing agent and the seller all know this deal is really solid. And now you've got a leg up on other folks that maybe haven't done their homework. Maybe they got some pre-certified thing where they didn't present any documents, or they don't even know their credit score yet. Like, you need to go through the process in today's market of basically almost getting the mortgage without having a property yet. And it's going to make it so much easier for you to get your offer accepted and taken seriously. So you got to call the lender first, then you start going out and looking at homes. If you're out looking at homes, you're just sort of daydreaming. You're not really in the process because you're so far behind where your competition is going to be, who's going to make offers on that same house.
Rochelle is asking this question. You can see it right here. She's saying, when will it be safe, viable, sensible to buy a house again? Hey, you kind of touched on that a little bit, but people do feel like it's kind of like nonsensical to go out there and buy a house. The way things have been so crazy, it's like the Wild West out there. But you're saying, hey, Rochelle, who, by the way, Rochelle Riley is a very famous writer here in Detroit, and she writes a lot about a lot of topics, but she has a question for you, David. She wants to know what you think.
Yeah. Well, I think it depends on how you look at it. I mean, a lot of people said the same thing 2 years ago, and here they are now having gained, 30% on their home value and 300% on their money, depending on how much they put down. We can get more into that in a second. But, it's hard to time these things. So here's how I feel about it, is that when most people are moving or they're making some kind of a decision, whether it be their family or they're a first-time home buyer and they want to own a home, again, it's very hard to time the market. So I don't know that waiting until next spring, and I'm just using that as an example,
right,
is going to be a lower interest rate and a lower price on the house. If I had to say, I would tell you I think the interest rate's probably going to be higher and the house is probably going to cost more than it does today. That would be the logical conclusion that most folks would come to. Now, we don't know that, but that would be my best guesstimate. So now is as good a time as any if you think rates and home values are going to continue to go up. Now, if you're willing to wait 2, 3, 4 years and we get a correction in housing prices and mortgage interest rates dip again, I mean, you could do that, but I don't know how likely of a scenario that is to be able to time and or predict. So, again, I think it's a tough thing to sort of wait out the housing market. So if you're making a family decision, we need more space, or we're relocating, it's kind of a bit of a no-brainer. But if you're just sort of buying to rent or own, if you've been renting the last 2 years, you've lost a lot of money compared to your neighbor, the homeowner. That's not always the case. I mean, we've seen unprecedented gains in home appreciation in the last 2 years, but you could play this game all day long and you may or may not be right. A year ago, you'd have been wrong. So I don't think a year from now you'll be right either, but it's a good question and it's certainly tough to predict.
Yeah. I mean, look, we were betting odds here like we do on March Madness. It'd be a different story because it's just a game, but here we are talking about our livelihoods and our hard-earned money, but lots of great questions coming to us right now. This one's from Denise, and Denise is saying right here, at this time with everything going on with the world of prices, everything so high, I would have thought that the Fed would have waited before kind of raising this another quarter. What are your thoughts on that?
Well, I don't think the Fed had a choice. I mean, if you look at what most experts think, they think the Fed should have acted earlier. Now, there's an argument on both sides, just like there is on everything. I think that the Fed beginning the process of raising rates, in my view, was probably smart. I think that you could make an argument of some tangible reasons over here why it wasn't, but I think there's more over here in this column as to why it was. So I think, depending on exactly what you sort of value in the economy may dictate what you think. But I think, again, most experts that follow the Fed and the economy would tell you maybe the Fed should have acted a little earlier than they did, or they were on time. I don't think a lot of people feel like that they should have waited. But, again, time will tell. I mean, the Fed does the best that they can with the information that they're given to try and, to some degree, right-size the economy. And I think the inflationary pressures, probably the biggest story. The only way to combat that is through raising rates.
If you're just joining us, we're talking to David Hall with Hall Financial. He's here to answer your questions about the Fed raising the interest rate or anything else money-related. We have lots of questions coming in right now. This one coming to us from Eric Mitchell. You were talking about housing earlier, and Eric is saying, hey, what's the difference between being pre-qualified and being pre-approved? That is a good distinction to keep in mind.
Yeah, it's really important. Thanks for the question, Eric. I think that if you think of it this way, what a realtor or what a home seller would expect if they're accepting your offer is you're ready to go. They want to know that you're ready to go. So the pre-approval basically says you're ready to go pending the property. These pre-certifications and pre-this and pre-that, they just don't really mean a lot. And to realtors, they know the difference, and they're sort of running the show as it relates to these transactions of, the negotiations between, hey, I got a buyer, your seller, my buyer's really solid. They've already been through the pre-approval process, great credit score, great income. They're in good shape. They can buy this house. They're ready to go. That's a really important thing. And I think these little distinctions around who's who, what they really want to get at is who's ready to buy and who wants to close on a house. And they're not dilly-dallying around anymore. I think that's important. One other stat, too, I wanted to give you, Roop, just commenting on something I was talking about earlier, is everybody talks about home appreciation as a function of the value of the house. So in other words, if 2 years ago you bought a $200,000 house and it went up 15% per year, now the house is worth $260,000 after 2 years. But if you utilize, let's say, a 5% down mortgage, which is very common. In fact, the average down payment in this country is 12% on average. So, a large number of people are putting 5 and 10% down that are buying homes. And why wouldn't they when you could leverage a mortgage at an incredibly low fixed interest rate? But anyway, if you purchased a home 2 years ago for $200,000, your home's now worth $260,000. Everybody thinks you made 15% a year. But the reality is if you put $10,000 down, and let's just say you had $5,000 in other costs to throw in there. That's probably a high number, but let's say to get the deal done. You actually made 4 times your money. You put in 15, now you've made 60. And there's not a lot of places in 2 years that you can 4x your money. Now, of course, you have the payment of the mortgage. I get that. But if you put sort of apples to apples that you'd be renting for something similar, let's even say that you were going to pay a little bit more than you were renting. So let's bolster it up. And let's say you spent $20,000, not the 15 I talked about earlier. Now you've 3 times your money. So folks that bought 2 years ago, 3 years ago, 4 years ago, they talk about, they've made 10, 12, 15% on their house. They really, in a lot of cases, made 200 or 300% on their money, which is incredible, especially considering if you're a first-time home buyer and you bought a house like I just described, you just turned your, let's call it 20 grand into 60. I mean, that's a lot. That's powerful numbers. And that's something that, I've always kind of coached up or worked with realtors on so that they really understand that piece of it. And I think that that's an incredibly powerful thing when you talk to homeowners. Now, we don't always see this type of appreciation, but the numbers are still really good. I mean, even in an average market, you're going to see, let's say, a 30 or 40% return on your money over 2 or 3 years, historically, which is incredible. You're not making that kind of money anywhere else on your money. And that's the power of home ownership and using the mortgage as the vehicle. I think that's important to share. I hope I didn't lose too many people with the numbers because it can get a little complicated, but I try and, simplify it.
No, not at all. I think it's great. I mean, you're the expert. You're out there talking to people, and you're seeing the trends, and anyone out there who thinks this is anything but just exactly what's going on out there has another thing coming. This is exactly what we know is happening outside right now. By the way, someone named Hawthorne says, bingo, this guy is spot on. Props to David Hall, right? I mean, that's a good thing. Listen, before we wrap things up here, by the way, if you have any other questions you want to ask right now, David Hall with Hall Financial will take a last question or two here on our live YouTube channel. But in the meantime, I want to just kind of turn the table over to Dave and just let him. I wanted to ask you just two final questions. One, the biggest misconceptions or misnomers when it comes to getting out there and making a purchase that's this important given our current environment.
Well, I mean, there's a bunch of them. I think that the biggest one is for people that think that they can time the market, or they think that they can sort of outsmart, interest rates. People, well, I'm going to wait because I think rates are going to go down. I mean, I've heard that a lot over the years. I mean, nobody knows that. Nobody really knows that. And rates are more likely to go up than they are to go down. And I say that, but anything can happen. So I think trying to outsmart the market is tough. That's why my advice as it relates to purchasing a home is do what makes sense for you, especially today. Again, historically speaking, very low fixed interest rates. On top of that, you have a very robust housing market that's going to continue to go up. Now, some people are more conservative or more liberal in terms of how much they want to buy versus like what they have. So I certainly profess a conservative approach. I don't think you should put all your money into buying a house by any means. But I also think that historically, if you look at any 10 or 20-year chart, purchasing a home has been a part of most people's wealth building activity. And so I think trying to sort of outsmart the system usually doesn't make a lot of sense.
No, that's great advice. Kevin has this question for you, David. Kevin's saying, are there any programs or incentives out there for going solar, and will that increase the value of my house?
It's a good question. I've had some guys in the solar business approach us recently, and they have some statistics that show that, solar sort of where the world is going to move. It can be an expensive investment to put solar in. I think it's a little unknown how the future of solar is going to look from a standpoint. Is everybody going to want, 20 years from now, is everybody going to want solar powered homes? I mean, I don't know that, and I'm not an expert in that area, but it's certainly an interesting trend that is starting to develop. And I'm not an expert in solar by any means, but I've talked to a few people in that business, and it certainly is something that on the horizon could be a part of what we do and could be a part of a lot of new home builds moving forward that, as we know, could set trends for maybe remodels on existings. It'll take us a ways to get there, but I'm certainly hearing some good things about solar. And I think that homeowners that have invested in it, I've gotten some good feedback. So, I think, again, I'm not an expert, but there's some good stuff out there.
I guess my question is, we've been talking about solar for a while, and the solar panels have been around for a long time. You think if it was going to incentivize or catch on more, it would have happened by now? Or do you think maybe we're seeing a resurgence now that we expected to see before? What are your thoughts?
Well, it's a good question. I don't know how common it is for people to install in their homes because it's a big investment. I think as financing of solar has potentially gotten a little cheaper and easier. I think that that's a big hurdle that people had to get over with it. But, a lot of these things, they take time for them to really become a big part of housing. It's hard for me to say. Again, I don't necessarily have any great advice on that because I'm not an expert in that area, but I have heard rumblings that it's picking up steam.
So finally, our question to you is going to be this. As we move forward here, and we expect that perhaps the Fed will increase interest rates once again, what is the timing of that? And, people like Jay, who talked about buying a minivan, waiting is not a great idea because the Fed may increase interest rates again. How long do people have before you think that's going to happen again?
Well, the Fed is going to meet again in 6 weeks. And so at that time, in my view, they're going to raise a quarter again. And just like this quarter, that won't necessarily have immediate impact on the market. But I've said it before and I'll say it again. If you're kind of waiting on something, it's probably going to get a little more expensive as it relates to financing of it. Now, hopefully, some of the stuff that we have been waiting on that are supply chain related, or maybe just your general food in the grocery store or gas prices, hopefully they will come down. But if you're going to finance something, rates for financing are probably going to be inching up throughout the year. Again, hard to exactly predict everything that will happen in the market, but I wouldn't be waiting on something if I'm considering purchasing, refinancing, getting a car. I just don't see that, your 6 to 8 month time horizon means it's going to get cheaper. I think it's going to stay the same or get more expensive given the information we have today.
I don't know if you can answer this last question coming to us from Phil. Phil is saying, what are the odds of getting USDA loans in this market?
Well, you can get a USDA loan. They're a little bit more rare. I think that, your opportunity to get an offer accepted is usually easier on a conventional loan because they're quicker. More of your sellers want to take a conventional loan versus an FHA or a USDA approval because those just tend to be a little trickier historically. But there's certainly lots of good FHA and USDA loans that are done every single day. But given apples to apples to go conventional or USDA, if you had the choice, most sellers are going to feel more comfortable with a conventional loan. Closes quicker. It's got a bigger opportunity for success. There's not as many guideline type things that you have to hurdle during the process. So, but they're certainly out there and they're done every day. But conventional is probably a little easier.
All right. I know you got to go, but we keep getting questions. I want to ask you one last one, David. Thank you for this. Hawthorne is saying Goldman Sachs has predicted that the real estate market will increase by 16% this year and another 14% increase in 2023. I know you talked a little bit about growth and what's expected, but what's your take on that?
I think it's really hard to make a prediction on 2023, much less 2022. I don't disagree that I think housing values will continue to go up. I think 16 and 14% is really aggressive coming off of two 15% plus years. I mean, that would mean that your house value would have gone up nearly like 60% over a 4-year period of time since 2 years ago to 2 years from now. That'd be incredible. And housing obviously would be, for a lot of people, not as affordable as it is today. But I do think that values will continue to rise in the foreseeable future. I just think that those numbers might be a little aggressive as to what we're going to see, but we'll see.
David Hall with Hall Financial. It's good to see you. We thank you for joining us today here on the Fox 2 YouTube channel and, of course, streaming on fox2detroit.com. Really great advice, helpful perspective, just stuff that, we'd have to go make an appointment and sit down and really chat with people. And let's be honest, so many people that talk this talk are unable to really communicate this stuff the way David did. So thank you very much for being so clear and understandable to everybody who's watching. And David, always good to talk to you. I hope we can stay in touch and we'll be talking really soon.
Yeah, Roop, thank you, and appreciate you doing this with us. Hall Financial, we're very proud of what we've done and continue to do, not just, with loans, but in the community. And I just want to, thank you for having us on and even just doing this with other folks as well to spread good information to viewers about whatever industry is you're talking about. I think you're doing a really good thing here and appreciate you having us on.
Well, David, thank you so much. We appreciate your time. We thank you for your perspective, and we're not done here on the Fox 2 YouTube channel, on fox2detroit.com. We know that during the day you're busy. You watch us at night, you watch us in the evening, you watch us in the morning, but then you want content in the day as well. And so we're going to be here on the YouTube channel and on the streaming sources here at Fox 2 to make sure that you are getting your weather, your news, and everything else, and a lot of perspective that we can share. So thanks everyone for joining.